Hello and welcome. In this month's on-demand webinar, OJM Director of Financial Planning, Michael Lewellen, CFP, discusses the Backdoor Roth IRA strategy and its recent confirmation by the IRS as an allowable transaction. Michael compares Roth IRAs to traditional IRAs, reviews IRS rules, and explains how the Backdoor Roth IRA strategy can be an effective step towards tax diversification. It's important to note that this webinar is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books, including our newest book, Wealth Management Made Simple. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
So today, the agenda, what we're going to look at. We're going to break down what is a Roth IRA. Most of you are probably familiar with it, but it makes sense for our discussion to break it down. IRS limits and rules, how the actual backdoor strategy works. There are some differences to it, and then the next steps for anyone at that point. So a Roth IRA. So the Roth IRA, what you're doing here is you are making after-tax contributions to a Roth IRA, and they are growing tax-free. And the advantage, obviously, is that they can be accessed tax-free. So you put dollars in on a post-tax basis, they grow tax-deferred, and you can pull those dollars out tax-free. It's a good strategy to hedge against future taxes. One of the other advantages is that there is no required minimum distribution. So from an estate planning standpoint, this can be a good place to have assets as well too. The distributions are not included in gross income, so in retirement that could be helpful on the taxation of Social Security is really where that can come into play. When you're looking at, when you do the conversion or make the contribution, there are scenarios where there could be a 5-year qualifying period, and we'll talk a little bit more about that as we move through the webinar. So let's break down the Roth IRA versus the traditional IRA. That is important because one of the things that we're going to talk about is making the conversion from a traditional to a Roth IRA, just so we kind of see how they mirror each other. The Roth IRA, again, it's not a deductible contribution. You're able to do $5,500. If you're over 50, you can do what's a catch-up provision to $6,500, and as we said earlier, it grows tax-free and come out tax-free. There are some scenarios where a 5-year holding period may apply, so you want to be aware of that. Generally, if you're making normal contributions to a Roth IRA, those generally don't come into play. But again, if you're doing conversions, there are scenarios where it can. Traditional. You can see there are scenarios where it could be deductible. For our clients and for most people listening to this, you're probably not if you have a 401k, if you have a 403b, you have a plan, and then also there's income limitations on there as well too that prevent you from deducting it. But you can, the same thing, you can put the $5,500, the same catch-up provisions, the $6,500, everything grows tax deferred, just like in the Roth, but when you pull those dollars out, they're going to be taxed as regular income. And there is no minimum holding period there. So let's take a look at the concept of tax diversification. So if you're asking yourself, why would I consider doing this? What would be the goal? What am I accomplishing? What we tell clients is it's a step towards better tax diversification. So if you have a 401k, a 403b, cash balance plan, defined benefit plan, for all of those dollars you're putting in, you're getting a pre-tax contribution. So that is lowering your taxable income. That's a very good thing. We all want to pay less in taxes. Grows tax deferred. When you pull those dollars out, then they're going to be included as regular income. So it's going to be taxed just as income, whatever the income rate is at that time. The second bucket, the orange bucket there, would be outside of qualified plans. So think about if you have a taxable or brokerage account, real estate can be included inside of there. Inside your brokerage or taxable accounts where you're going to own your stocks, bonds, that type of thing. So there you're making after-tax contributions. so dollars have been taxed. Everything is growing. There can be taxing that's going on throughout there, depending on its capital gains, so there's short-term and long-term. But if you think about that, in most scenarios, if you're managing it properly on the back end, you're going to pay long-term capital gains, which is going to be lower than regular income. So it's positive. So you've created some diversification. Now, one of the most overlooked buckets is the tax-free bucket. And some of that has to do with how do you get into it. You want to make sure you're maximizing the other buckets first, really, before you look at that. But tools that can be used there, cash value life insurance is something that we see people use in a properly designed contract. Things can grow, cash can grow tax-free and come out tax-free. Municipal bonds, not a very favorable time right now, but that could change, obviously, where you're getting tax-free income from there. And then your Roth IRA. So that is a tool that you're able to use to create that tax diversification to get more dollars into that tax-free bucket. Now let's talk about the Backdoor Roth IRA Strategy. Now, for many of you, you may have heard of this before because it's actually been around since 2010. There was some tax reform that took place that allowed people to start doing the conversions there. What always was kind of hanging over that, there was gray area if you would talk to CPAs specifically. There wasn't clarity from the IRS. What the IRS did with the most recent tax reform is provide clarity, and they said, yes, you can absolutely do the backdoor Roth IRA contribution and conversion. They didn't say the word backdoor. They don't like that term, but you can use this strategy. So by using this strategy, what we're doing is we're working around income limits on the Roth IRA. So you'll see in a couple slides there are limitations for single and married filers. For a lot of our clients, they exceed those limits. Essentially, if you're married and you make over 135, or I'm sorry, if you're single and you make over 135, or if you're married and you make over 200 grand, you can't make a direct contribution. So you have to go what we would say is the backdoor route into the Roth IRA. So there's really two ways to go about that. You can make a non-deductible contribution to a traditional IRA. So you open up a non-deductible traditional IRA and you contribute the $5,500 to $6,500. Then you immediately convert that to a Roth IRA. So there's no gains or nothing that's taken place there. So you immediately convert it. That's a strategy that most firms are going to be familiar with doing there. And the advantage obviously there is you've moved it from a bucket that any growth would be taxed as regular income into a bucket that's going to be taxed or that's going to be tax-free. So that's the one way to take advantage of this strategy. What you're also able to do is if you have an IRA balance. So let's say you work somewhere, you rolled your 401k over, you can convert that balance as well too. Now, anything that you would convert would be included in your taxable income. So that's really important to remember. You don't have to do all of it. You can do a portion of it, but that's a strategy for getting a larger portion versus just the 5,500, the 6,500. Some people may feel, well, is that even a compelling enough amount to do? If you wanted to create tax diversification, you can actually convert all or some of your IRA balance into a Roth IRA as well too. And then obviously the advantages there. Now in either scenario, you have dollars that are in that tax-free bucket. And from a tax diversification standpoint, for our clients from a planning perspective, we feel that that's very positive. Rules to remember, you must have earned income to do this. To do the non-deductible the contribution strategy, and not be older than 70 and a half. The distribution rule again is something that is important to remember. There are again what happens there when you're doing the conversion. There can be a 5-year wait. Now, if you're doing multiple conversions, you can have staggering periods of time there, but a conversion puts in a 5-year rule. If you were to take anything out from that amount of that conversion, there could be a 10% penalty on that. That can get really difficult to manage, but definitely work with your CPA or advisor to talk about that. The pro rata rule, if you were to do a conversion of a large IRA, so the simplest way to think about this, the best example, let's say you have $95,000 in a IRA that you rolled over from a previous employer 401k, that type of thing. Then you make into a non-deductible IRA, you make a $5,000 contribution. And your plan obviously is to convert that $5,000, right? Well, the problem is the pro rata rule. So the IRS says you have to look at your entire IRA balance when you make that conversion. So if you were to convert and say, okay, I've got the 95 and I did the 5, well, they look at the entire IRA balance of everything that you have. So what you're able to do, what you have to do there, then, if you were to convert that $5,000, 95% of it, that's the pro rata percentage, would be taxable. So 95% of that 5,000 would be included in your taxable income there. So that's something to think about. They do, they have some rules in place where you can't work around and just do the contribution and not convert your IRA balance. So that's something that you want to make sure that you're taking into consideration. Here are those income limits we talked about for a single filer. Remember, we kind of talked about this strategy, but if you fall into these income ranges, you can make a direct contribution to a Roth IRA. So if you're single and your income doesn't exceed $135,000, you can see there's some phase out there starting at $120,000. You can make a contribution. Phase out starts at $189,000 for married filers and goes up to that $199,000 number. So people that fall into those under or within that range can make direct contributions to a Roth IRA. For a lot of our clients, that's not the case. So in summary, the backdoor Roth IRA strategy really allows clients to get around the income limits of the Roth IRA. The conversion obviously is a way to get a large portion. So if you were to take, a large IRA balance and convert that, it gives you the ability to move more dollars into that tax-free bucket, thus creating more tax diversification from that standpoint. I think for any client that is looking to accomplish greater tax diversification, evaluating this strategy for your situation would make a lot of sense. It doesn't, obviously there are scenarios where it may not be appropriate for you. We would be happy to discuss that with you to see if it would be appropriate for you. When at the end of this webinar, you'll get the opportunity, obviously, as I mentioned before, to download any of our resources, our books, or to request hard copies, but also to schedule a consultation to discuss what that would look like specifically for you. So using this strategy, what would be the most efficient way to do that and whether or not it would be appropriate. So we'd be happy to schedule a time and discuss that with you. We appreciate you taking the time today and look forward to speaking with you in the future.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.